Basically, I'm having trouble identifying the industry of which my company is in. Do I just make my best guess?
You have to, right? What other choice do you have? There's no.
I mean, my company is doing software and equipment for indoor plantation.
Indoor plantation.
Indoor plantation.
It's agricultural.
Agriculture?
Yeah.
And do I separate into like machinery, software, because they do software?
No, just make it agricultural. So it's a derived demand. Yeah.
Okay, folks, a couple of very quick reminders in case you need them. The first is if you want to get the feedback on your project, it's completely optional. You need to get it into me by Friday. But I'll be quite honest, it's not a hard deadline. So if you're not done by 5 p.m. on Friday, it's not like I'm not going to look at it. I'd like it somewhere around Friday. Do you know what I mean? I don't want it like in May 5th. So if you're going to do it sooner rather than later. About 15 of you have already turned in your valuations. This is not meant as kind of a, I'm not trying to prod you, but those people I've sent the valuations back already. So if you've sent in evaluations, there were a few that came in this morning that I haven't looked at yet. Usually you will get it back pretty quickly if you send it sooner. If it comes in at Friday at 5 o'clock and there are 450 of them, then I go through them in chronological order. So it might take you a little while. So if you want speedy feedback, try to get it in sooner. If you're willing to wait, over the weekend, then you can send it by Friday. If you're not done by Friday, still send it in to me. I will take a look at it. Okay? The other is, and this should not come as a surprise, but it's not going to be a pleasant surprise if it is, which is, what's coming a week from now, right? It's your second quiz, right? So I will send you an email about what the second quiz will cover. And I know you have two tracks. You're working in evaluation and the second quiz. Don't think of them as mutually exclusive, right? What you do on evaluation is actually going to be what the second quiz is all about. It's about discounted cash flow valuation, how we deal with options. So try to understand the mechanics of what's going on behind the spreadsheet, because that's what the second quiz is about. Okay? So let me start today with a couple of details that we're going to hit today in the context of discounted cash flow valuation. The first is actually very relevant to your project. Okay, so you finished, I don't know how many of you are done or pretty close to being done in evaluations. When you're done, of course, you get a value per share, right? And there's the price per share. And for some of you, the numbers are different. And the first question you ask is how different is too different? Right? Is it 30% different? Okay. There is no okay answer here because it depends on the company. It could. The second thing you're going to run into is when those numbers are different, it makes you uncomfortable. So let's start with that question. You come up with a value per share. There's the price per share. Let's think of the potential ways you can explain. The first is you can tell yourself that you're right and the market is wrong. It requires a very special ego to be able to pull it off. And if you are, I'm an all. Right? The second, and this is the more likely scenario, especially if this is the first time you valued a company, one of the first times, is you're convinced that you're wrong and the market is right. You know what's going to happen when you believe that? You're going to revisit your valuation over and over and over again. And each time you revisit it, the value is going to magically move a little closer to the price. You're going to tweak the growth rate that look high. You're going to play with the numbers till you get the value close to the price because it's so much more comfortable to be close to the price. Because that way, if you screw up, you have lots of company. But remember, if that's what you're going to end up doing in evaluation every time you do this, I understand that this is the first time I can see it happening. But if this is what you do on every evaluation, why bother? I'll tell you what the most likely answer is, that you're wrong. The market is also wrong. The market doesn't have some magical crystal ball. It's making its own consensus judgments. You just hope you're less wrong than the market. That's basically what you're hoping for. You can't both be right. That's off the table. And I think I pretty much hit every conceivable choice. So the last choice is not even a choice. Like if you did a Venn diagram, I pretty much covered every single outcome. So the odds are that you're wrong. In fact, let me take that. You are definitely wrong. And it's part of the process of learning to live with that uncertainty. Today, I'll give you a couple of tools that you might bring in to make yourself feel more comfortable. But that's something to factor in. Here's a second. Today, we're going to also value young companies. The young companies, one of the things you find is these companies often have to issue shares in the future to keep going. It's a feature of the company as it's grown. So let's say you've done a discounted cash flow valuation of a young company, you've taken cash flows to equity, you've discounted the cost of equity, come up with the value of equity of 100 million. The company has 10 million shares outstanding. But based on your estimates of negative cash flows in the future and the need to issue new shares, you think this company will have to issue 2.5 million more shares in the future. Think of it as expected dilution. I have a very simple question. You got $100 million equity value. To get the value per share, should I divide by the 10 million shares, the actual shares outstanding, which will give you $10 per share? Should I divide by 12.5 million shares, which includes the 2.5 million shares that you will have to issue in the future, which will give you $8 per share? Is it some number between 8 and 10, more than 10, less than 8? So it's actually a question you're going to run into anytime you value young companies. It's what's the share count I should use to divide the existing equity value? What's the answer to that today? And why? 10 million, 12.5 million, some number in the middle. Yeah. Now, why did I issue the shares though? What did I do with that money? And it showed up because growth itself doesn't get funded. It's cash flows that are negative that I'm funding with that, the share count, right? Are those cash flows in my present value? When I did the 100 million, did I take the present value of those negative cash flows as well? Well, to do a present value, I'm counting every cash flow, including the negative cash flow, right? You see where I'm going, though. If I've taken the present value of the negative cash flows, I've already lowered the value of equity for my expected need for future. If you put the 12.5 million, you're actually double counting the share count. It actually makes our job much simpler because imagine how much more messy it would be if I ask you how many shares will you have to issue in year one, because then you'll have to guess what the stock price will be a year from now. This is a huge blessing. It means when you value young companies with negative cash flows, all you have to look at is the share count today, even though you know the share count will change, because otherwise you'll be double counting those shares. So let's get started. Now, if you remember the last session, I left you with a question about target prices. So that in case you don't remember, let me reshare here. So let me review where I left you, right? I did a valuation of Con Ed. Remember the boring regulated utility? I came up with $42.30. But in a discounted cash flow valuation, that's a value today. The stock price was $40.76 price today. And in traditional discounted cash flow valuation, we compare the value to the price today and we make our decision. But I also said in conventional sell-side equity research, analysts are asked to give you a target price. So I want you to use the numbers I've come up with. So you've done a DCF valuation and convert it into a target price a year from now. Okay, so I'll give you the numbers. The value per share, the DCF value is $42.30. My cost of equity is 7.7%. And I expect the stock to pay $2.36 in dividends next year. I'm going to argue with those three numbers. You should be able to tell me what my target price will be 1 year from now based on my DCF valuation. Anybody want to help me here on how I would get from the value per share today to an expected target price 1 year from now? When I say the cost of equity is 7.7%, if this stock is fairly valued at 42.30, you know what I'm saying, right? Your return if you hold the stock for a year would be 7.7%. That return comes from two places, price appreciation and dividends. If you take the 42.70, grow it at 7.7%, that'll give you an expected price a year from now. If you subtract out the dividend, because the dividend is a portion of your return, you can check out the math. 42.30 grown at 7.7% minus the dividend gives me $43.19. Check the math if you want. That's my price 1 year from now. You're saying, what do I do with that? The stock price right now is $40.76. If I go and buy that stock today, and you're right on your valuation, I wait a year, I'm going to go from $40.76 to $43.19, which is going to give me a return of 11.89%. Remember we said one of the essence of an undervalued stock is you earn more than you need to. You need to make 7.7%. And because the stock is trading at a lower price, I'm going to make 11.89% if my valuation is right. So if I ask you for a target price next year, just use your cost of equity. You get the price 1 year from now. What if I ask you what will the target price be 5 years from now? Some analysts are fond of giving you 5-year targets. Just repeat what I did for 1 year, do the compounded effect, and you can give me the target price in 2 years, 3 years, 4 years, 5 years, based on the cost of equity and what your DCF value is today. So if you're in a setting where people say, I want target prices, don't give me this DCF value crap today, you can take your DCF value and convert it into target prices using your own cost of equity. So Con Ed was easy. Regulated utility, stable company, pays big dividends. Let's make the problem a little more messy, but not that much more. You're all familiar with 3M, right? 3M is a company that makes absolutely stupid stuff that everybody needs. Like what? Post-it notes. The guy who invented this should get a Nobel Prize for something, right? It's kind of an act of genius. I bought 3M, I remember, about 4 Christmases ago. You know why I bought GM? Because Christmas, I have to hang up lights. And to hang up lights, you need hooks. So I went to the store and said, this is highway robbery. Have you ever bought these 3M hooks? It's like $5 for this little piece of plastic. The margins on that might be like 96%. And one of the lessons I've learned over time is when a company is ripping me off too much, I try to buy shares in the company. That way I'm ripping off myself a little bit. So I feel always better about ripping myself off. So this was actually a valuation of 3M that I did on September 12th of 2008. Is there anything significant about that date? Is it? Do you remember what started to happen? September 12th was a Friday, and the weekend after that was the weekend that that Lehman was in trouble, and then the world fell apart. I would love to tell you on September 12th of 2008, I was looking past the weekend. I was telling myself, there's a crisis coming. I have to behave differently, but I'd be lying. I had no idea what was coming. So think of this as valuing a company on September 12th. I was valuing a nice, mature company with a traditional business model. I could see their financials. Relatively easy case, right? You can see how they made money. And I thought, and this was of course wrong in hindsight, that I was working in an economy which was a mature market where things wouldn't change very much. So without the benefit of hindsight, here's what my valuation looked like. I took their most recent year's numbers and they looked impressive. They had return on capital of 25.19%. One measure of how good a company is what it earns relative to the cost of capital. They're earning way above their cost of capital. They were reinvesting about 30%. Why so low? Because they were a pretty mature company. That not that growth, but not that much growth. I assumed that they'd be able to maintain that reinvestment rate and return on capital. So the story I'm telling of 3M is a company that's going to pretty much do what they've been doing for the last few years. 7.5% growth. At the end of the 5th year, I make them a mature company. In other words, you go through the checkbox, growth rate, you got the terminal value. What I got as my value per share with the assumptions I made on September 12th was $83.55 per share. The stock was actually trading at $70 per share. Now, it was a Friday, and I said, you know what, I should buy the shares, but I was too lazy. I said, I'll do it on Monday morning. Best procrastination decision I ever made. Because when we woke up on Monday morning, the crisis had begun. Now, one of the canards that you will hear from old-time value investors is if you do an intrinsic valuation of a company, it's kind of timeless. It's a bunch of junk. You value a company, everything can change. In this particular case, to show you how much can change, even if the company doesn't come out with new earnings reports or new information, I revisited the 3M valuation 4 weeks later. There were no earnings reports, so numbers look very much the same. So I'm going to show you how the crisis affected my valuation 4 weeks later. First, what's the essence of a crisis? The price of risk goes up, right? Default spreads go up, equity risk premiums go up. So first thing you will notice is even though the rating for 3M remained the same, the default spread had gone up significantly because we were in a crisis, higher cost of debt. Second effect of a crisis, the equity risk premium, because I'm doing implied premiums by day, had gone from 4% to 6%. Even if I changed nothing else about the company. Think of what's going to happen to the value of this company, right? It's going to drop, not because the earnings are lower, the growth is lower, but because I'm charging a higher price for risk. You're valuing a Russian company, right? Even if you assume everything about the company in terms of cash flows remains the same, I guarantee you, even if you do the valuation now with the adjusted discount rates, the equity risk premium for Russia is way up there, 5 times higher than it was a few weeks ago. You're going to end up with a lower value per share. What I'm trying to say is, if you're in the midst of a crisis, you have to revisit your valuations. You can't look at the valuation at 4 weeks ago, 6 weeks ago and said, that was pretty recent, I'll just stay with it. So I hope you don't have a crisis between now and May 9th. You know why? Because on May 5th, you think you're finished with your project, you put it away. And I think that's a weekend. So Monday you come in and the market is down 30%. Guess what? Your entire valuation might need to be revisited. So that's a 3M valuation, just to illustrate how much, even if you have a mature company, things can change if the market changes around you. So we talked about Con Ed, we've talked about 3M. Let's do one final simple valuation. My final simple valuation, I'm not going to value another company, but I'm going to value the entire S&P 500 index. Remember, if the value of something is the present value of the cash flows, there is no reason why I cannot value the entire index. Again, I'm going to take you back in time to November of 2020. It wasn't that long ago. But in case you've forgotten what November of 2020 looked like, March of 2020, of course, we had the crisis, markets had collapsed. Everything got shut down. November, we were still pretty much shut down. There was no vaccine available still. So this was actually 2 days before Pfizer announced that their vaccine was ready to go. No idea what was coming. The reason I did this was between March 23rd of 2020, when the market had dropped almost 35% in November, stocks had not just come back, they were actually trading at a higher value than they were before the crisis. And people said, that doesn't make any sense. And the first reason they said it doesn't make sense is they said the economy is in shambles. The unemployment rate was still in double digits. The economy had shrunk like 4% or 5% in the previous quarter. They said, how can markets be going up if the economy is in complete shambles? The second thing that came up was, even if you think the economy will come back, there's got to be some real damage that's been done to the economy. Shouldn't the index be lower now than it was before the crisis? So I said, okay, let's address those questions. Let's start with the first one. Is it true that when economies do badly, that markets also do badly? It's an empirical question, right? Because I can tell you, if I could tell you one story that it works and another. So I said, instead of listening to stories, why don't we look at the data? So I went back all the way to 1960 and I collected quarterly data on the S&P 500 index and real GDP. Real GDP is a measure, the purest measure you can get for how the economy is doing. So the real GDP goes up, you had a strong quarter, real GDP goes down, you had a weak quarter. So I have 60 years of data, 4 quarters every year, that's 240 quarters of stock returns and real GDP change every quarter. So what am I trying to answer? When the economy is doing strongly, does the market also do well? So I did a very simplistic test. I did a correlation between real GDP growth and what stocks were doing in the same quarter. It's called contemporaneous. Basically, I was looking. You know, the correlation was minus 0.06. There's close to no, even a little negative correlation between how stocks are doing and how the economy is doing at the same time. But stocks actually are not meant to reflect the economy right now. If you think about the history of stocks, stocks are designed to be forecasting mechanisms. So I said, hey, let me look at the link between what stocks are doing and what the GDP does next quarter. So basically, I took my data and I said, if I know what stocks did this quarter, what does it tell me about GDP 1 quarter ahead? The correlation became positive, 0.12. In fact, it kept climbing as I went 2 quarters ahead. At around 3 quarters, it peaked around 0.26. What does that tell me? Stocks are working as, they're trying to predict what the economy is doing. They're not perfect predictors by any means because the correlation is not 1 or 0.9, it's 0.26. So in November of 2020, when people said, how do you explain why stocks are doing well when the economy was doing badly? The response was, it sees a recovery coming by the middle of 2021. It's building it into stock returns today. But I said, don't take this to the bank and do something stupid. The correlation is still 0.26. So the first part of how do you explain stocks doing well in the market when the economy is doing badly, that answer is pretty straightforward. To answer the second question of, are they over optimistic, even if they think the stock, are they being more upbeat than they should be? The only way to answer the question is to delve into the numbers. So I'm going to give you the framework I use to value an index. I've used it on the S&P 500 multiple times, but you can use it on any index you want, the Bovespa, the Sensex, the Shenzhen, whatever index you want. I take the S&P 500, I know the value of the index. I'm trying to estimate the intrinsic value. What's intrinsic value? It's the present value of the cash flows you will get by holding something, right? The only problem is the S&P 500 has 500 different companies in it, large market cap companies. And I don't have the bandwidth to forecast each of their free cash flows for the next 5 years. So I cheated. What I meant by cheating is rather than do each company's cash flows and adding them up, which is feasible but tedious, I took the collective dividends and stock buybacks of all of the companies in the index. I made the assumption that that collective cash return is roughly equal to the cash flows of all of the companies. So I don't have to be right on individual companies, but collective. So what I'm going to do is instead of trying to forecast free cash flow, I'm going to forecast what those dividends and buybacks will be in future years. It's what I did for my implied premium, but now I'm doing it in a different context. So in my cash flows, I'm going to have dividends and buybacks going, which means I've got to forecast earnings growth and what percentage of that will be paid out as dividends. Now to discount these cash flows, I need a cost of equity. Remember, this is the index, so I don't need a beta. The beta is going to be roughly 1. So I need a risk-free rate and an equity risk-free rate. I at least have a sense of the ingredients I need to do my valuation. So I'll show you what the numbers look like in November of 2020. First, I needed to measure what will the earnings look like in 2021 and 2022. Now, if this were a nice normal year, you could just take last year's numbers and apply a growth rate. But in 2020, earnings had collapsed. People weren't sure what was going to happen in 2021 and 2022. Again, I don't have the bandwidth to go out and forecast the earnings for every company, so I cheated again. I looked at what others were estimating as earnings for the entire index. And by others, I'm talking about
there's a small band of analysts, most of them New York based, that project out earnings for the entire S&P 500. One of them is this guy called Ed Yardeni. If you go on Google and type his name, every week he actually makes an updated forecast for S&P 500 earnings for the next quarter, next year, and 2 years forward. And his forecast in November of 2020 for 2021 and 2022 was, while earnings in 2020 would be seriously damaged, down from 163 to 125, that they would come back partially in 2021 and mostly in 2022. So that was his forecast. He also reports what I call consensus forecast. This is all the analysts who track the index, what their forecast was. And they were forecasting, they were slightly more optimistic. They thought earnings in 2020 would be damaged, but not as much as Ed did, and slightly better earnings in 2021 and 2022. And finally, I also looked at what investment banking market strategists were predicting. They predict only 1 year forward earnings, as what they were predicting as earnings in 2020, just to get a sense of, are these people all agreeing? So here's what I see as agreement. They're all agreeing that 2020 is going to be a terrible year for stocks. At least the ones that are forecasting are assuming a bounce back, but not a full bounce back in 2021. And maybe a more complete bounce back in 2022. So at least I'm getting a sense of what are people thinking about earnings. Now let's talk about dividends and buybacks. Companies don't pay out all of their earnings, so I can estimate how much they will pay back. And to get a sense of what they might pay back, I looked at history. Historically, how much have companies returned? So every year I took the earnings for the S&P 500, took dividends and buybacks, and basically calculated each year what percentage gets returned. So basically dividends plus buybacks divided by earnings. So you notice that the number climbs 2007 and 2008. It's actually more than 100%. Companies are getting really, really lazy about just returning cash. Then you have the 2008 crisis. It drops down to 66%, and then it starts building up again. The median value was 83% over the entire period. US companies returned about 83.4% of their earnings as dividends and buybacks. Again, I'm getting a sense, I'm getting perspective. What do US companies typically do in a year? They return about 83%, but in a bad year, they can return 60, 65%. A really good year, they can exceed 100%. So I have a sense of cash flows from the index. And finally, I need an equity risk premium, because here I'm not computing an implied premium. I'm going to try to decide what a right premium is for the index. And here again, to give you perspective, if you go all the way back to 1960, the implied equity risk premium would have been 4.2%, the average. If you go back to 2000, it's about 4.86%. And we look at only the post-2008 crisis, it's 5.58%. So if I gave you, each of you, these three numbers and asked you to make forecasts, it's not like we'll all agree on a number, but at least we're starting with the same starting points, and we might make different judgments. Now, I don't know what the right number is, but I'll show you what I projected in November of 2020. I projected first that earnings would drop in 2020, which was not a huge surprise to anybody, but they would drop to 130 from 163. Bad year, for obvious reasons. I did assume a recovery in 2021 and 2022, but I did assume that some of that drop you saw in 2020 was permanent. You know what I mean by permanent? Even if COVID goes away, which we have no idea when that'll be, they're not going to come back. That Carnival cruise line earnings, never coming back. Nobody's getting on that cruise ship again. 80% is, will go away, but 20% is permanent. For 2020, dividends and buybacks are going to be damaged severely. Dividends are going to be down 20%. That doesn't sound like much. That's a huge drop in dividends. In 2009, for instance, dividends, or 2008, during that crisis, dividends dropped about 18%. I see a similar drop in dividends. And buybacks drop by more because companies can cancel buybacks much more easily, drop by 50%. So my story is building up. I'm seeing a bad 2020 in terms of earnings and dividends, a partial recovery in 2021. But I do believe going forward that companies, at least for the near term, are going to be more cautious about cash return. Why? Because they've come out of a crisis. So those are the assumptions that are going to drive the cash flows in the index: a recovery in earnings and a slower recovery in cash flows. Finally, to come up with the cost of equity, I need a risk-free rate. That was easy. I just took the T-bond rate. And an equity risk premium, I made the assumption, it was mine, that I would demand a premium similar to the premium I've charged since 2008 because we were in the middle of a crisis. I have pretty much everything I need to value the index. So let me show you what I'm assuming so that you don't accuse me of being in denial. I'm assuming, so these were my projected earnings and cash flows before the crisis hit. So before the crisis hit, I was projecting 156.34 in cash flows. After the crisis, you can see I've knocked down the cash flows. And especially in the early years, you can see how much I've knocked the cash flows down. So I've become much more pessimistic about future cash flows. My cost of equity is 6 points. So basically, I'm just adding up the risk-free rate to the risk premium. I am assuming that after year 5, my risk-free rate will rise. My equity risk premium is going to become more normal. I have pretty much everything I need. I have my cash flows based on dividends and buybacks. I discount them back using my cost of equity. The cost of equity is tiny because the risk-free rate has dropped. And what I get as a present value for the index, and this was in November of 2020, was 3,108. The actual index was at 3,270. I'm within shouting distance, the index. In fact, if you ask me, what are my conclusions, I'd say it's pretty close to fairly valued. I did this because I heard so many people tell me that there was no way the index could be worth 3,270. It must be hopelessly overvalued. And I said, you might be right, but looking at the numbers, that's not what I see. Incidentally, I updated this index value multiple times. The most recent one was at the start of this month, on March 1st, 2022, of an S&P 500 valuation. If you get a chance, go in and change the numbers that you don't like. So I let you change the risk-free rate, the equity risk premium, the cash flows will be returned. You can value an index. It's easier for an index like the S&P 500 because you have so much outside estimates you can use. But there's no reason, again, that you can't use this to value any other index. Remember I talked about being uncomfortable when you value a company. You're uncomfortable because you're making estimates for the future. What's worrying you? That you could be wrong, right? And you proceed to beat yourself up. What if I'm wrong? What if I'm wrong? And I told you, you are going to be wrong. It's a given. So, but one of the things that you'd like to do is make yourself feel more comfortable with your own assessments. So I'm going to give you a tool that I find really useful when I get really uncomfortable. And in November of 2020, I was incredibly uncomfortable valuing the market. Why? Because I knew everything could change. Now, normally when you do valuation, you make point estimates, right? What's your growth rate? What's your margin? What do you say? And you see this even in the FCFF Ginzu spreadsheet, I ask you to make things. And part of you is screaming, but I could be wrong. What if I gave you a chance to tell me how wrong you could be? Makes late. When I asked you for the revenue growth rate, I said, give me a number. And you said 20%. So what? I could be wrong. I said, what if you could tell me, give me a distribution for the growth rate? That could be any number from 12 to 28%. Same thing for each of the assumptions. Instead of giving me a single number, what if you could give me a distribution? It's called a Monte Carlo simulation. And here's what I do. I go into each distribution. So I took my 5 big assumptions in my S&P 500 valuation. I put distributions in instead of a single value. And then I go into each distribution and pick a number. It's going to be any number from the distribution. It could be high or low. And then I value the index. And I do it again and again and again. I did it 100,000 times. Sounds tedious and extremely difficult to do. It actually took me all of 45 seconds. Because there's this add-on to Excel called Crystal Ball. As Stern students, you actually have access to it free. Take advantage of it. You can actually finish your valuation in an Excel spreadsheet, a traditional valuation, and you can make it a Monte Carlo simulation in 5 minutes. All it'll do, it'll make you let you take that revenue growth, the margin, and the cost of capital assumptions you entered as point estimates, replace them with distributions. The default in Crystal Ball is 10,000 simulations. And it'll present the output as a distribution. So instead of telling you the value of the index is X, it gives you a distribution of value. The median value I got was 33,091, very close to what I got with my base case. But I can also tell you the range of values. Right? If I'm wrong, here's how wrong I can be. Think of how much richer this information is when you make decisions, rather than my say, here's the value, here's the price. You now have a distribution to base your value on. Any questions on, so you can download the Crystal Ball app from the apps section of Stern Life. So go in and try it out. It's really worth giving a shot. No? Yes. That's the part where you have to remember your statistics, right? I'll tell you what you're going to see when you open up Crystal Ball. It'll give you a choice of 53 different distributions. You know what your first reaction will be as you look at each distribution? What the heck is that? What's your only, let's be honest, what's your only distribution you remember from your statistics class? Let's face it, the only distribution you still remember is the normal distribution, right? So when people use Crystal Ball, often everything looks normal. Why? Because that's the only distribution you recognize. If you're going to use Crystal Ball, that is the investment you have to make. It's the investment in time to understand what a left skewed versus a right skewed distribution is. What a log normal, it's not difficult. In fact, on my website, I have a small paper on picking the right distribution. If you're going to use Crystal Ball, read that because it'll tell you what kind of distribution best fits a particular variable, how to tell whether to use a normal distribution, a uniform distribution, a triangular distribution. And it's, you know, if many of you are going to end up in jobs, you work with numbers, there's a lot of uncertainty. This is an incredibly powerful tool to have at your disposal in those jobs because it'll allow you to take your uncertainty and make it, you can face up to it. Any other questions? Yes.
Just the rate prices. Your evaluation, Russian company say now it's not price hike. Just the valuation.
Why would your value change for the price? Why is there a feedback loop when you say when you adjust for the prices? Where in your valuation is the price even an input?
Just valuation.
That's what I'm asking. Why would you adjust the valuation? Because the price changed. If the price changes and there's a fundamental reason for the price change, you're going to adjust for that, right? In the case of the Russian crisis, what changes? The price of risk for investing in Russia went up. You might revalue the company the higher. You're not doing it because the price changed. You're doing it because something fundamental changed. Valuations change because fundamentals change. There's no price change effect that feeds back into valuation because you don't care. That's what you're comparing the value to. Okay? So unless there's a good reason for the price change, it's not going to show up in your valuation. So as GameStop went from $30 to $400, your value is not going to change just because the price went up because it's completely irrelevant, right? It's based on cash flows, growth, and risk, and what you think about GameStop as a company. So there shouldn't be a feedback loop. If there is, you're opening a very dangerous door where you're going to keep pushing your valuation up just to try to keep up with the price. And that's not the reason we do intrinsic valuation. So now let me move on to what I call the dark side of valuation. Sounds scary. But to understand what I'm going to do next, I'm going to reframe valuation. Now, when you do valuation, you sit there with a spreadsheet, you start entering inputs, and you think your value comes from that spreadsheet. But if you think about it a little more, really, valuation is about answering 4 basic questions about your company. So think about your company and think about how you answer these questions. The first question I'm going to ask you is, what are your cash flows from your existing investments? Because your company's been around, it's got project, what kind? And you'll answer the question by looking at the financial statements, telling me how much earnings the company made, what its cash flows look like. That's what you learn by looking at current financials, what the value of existing assets is. Think of that as the easiest of the 4 questions to answer. I'm going to have a second question, and notice how I'm going to phrase this question. I'm going to ask you, what's the value that you're going to add or destroy with future growth of this company? You know why I phrased it that way? If I ask you, what's your growth rate going to be? You can give me a 20%. But remember, growth can add value, do nothing for value, destroy value, because growth is a double-edged sword. The good side of growth is growth makes your numbers look bigger. The bad side of growth is to get that growth, you have to reinvest. Whether it's through a sales to capital ratio or return on invested capital, it doesn't matter. There's a reinvestment that goes in. The net effect of growth is whether the good side outweighs the bad side. So I'm asking in your company, what's the value added or destroyed by growth? The third question I'm going to ask you is, how risky is your company? Notice the way I phrase that question again. And ask you, what's the beta for your company? Because that's kind of a means to an end. Is your company safer or riskier? And if you want to use a beta and a cost of equity and a rating to get there, fine. Or if you just want to go to the 90th percentile, like I did for Uber, that's okay too. And then I want to ask you, when will your company be a mature company? You know what a mature company is? The company that grows at a rate less than or equal to the economy. Why do I care? Because that's when I can put in closure and estimated terminal value. Every valuation, those are the 4 questions that drive your valuation. So let me start with an obvious statement. When those questions are easy to answer, valuation becomes easy. When those questions are difficult to answer, valuation obviously is not just difficult, but people give up. So think of the scenarios where valuation is going to be easy, those 4 questions. First, you got to have a mature money-making company with a lot of history, right? 3M on September 12th of 2008 was an easy company to value because of long history. I see how, and also because I assumed that the economy was mature, right? 3M on October of 2008 became a more difficult company to value because all those questions became messier to answer because you're in a crisis. If every company value was a nice, mature company in a nice, mature market, why are you in this class? You don't need this class. In fact, you probably don't even need yourself. You could probably automate the whole thing and it could get done. Put simply, we learn valuation not because we want to value easy companies, but because we want to value difficult to value companies when those questions are difficult to answer. So let me give you a few cases where valuations are going to be difficult. The first is young companies. We'll talk about what it is about young companies that makes those 4 questions difficult to answer. Valuation becomes difficult when you have companies that don't fit the accounting mold. Let me explain. If you have a technology company or a pharmaceutical company, what do accountants do that really screws you up? They take R&D expenses and they expense them, rather, which means that when you value these companies, even if it's a mature company, you got to redo the financials. Answering the 4 questions became much more difficult. And valuation becomes difficult when you have truncation risk. You know what I mean by truncation risk? You'd normally say, what if my cash flows in year 3 are wrong? With truncation risk, you ask, what if there's no year 3? If you have a company that's in distress, that could be nationalized. My problem with valuing any Russian company now is I can value Sberbank. I have no idea whether the Russian government will nationalize the bank because they might feel it's too critical for the country for it to be a publicly traded company, which means the bank will exist, but my equity is going to be worth nothing. So I'm going to go through a whole list of difficult to value companies. I'm going to start by looking across the life cycle. I'm going to start with young companies and talk about what makes them a challenge to value. I'm even going to focus on mature companies and argue that when they transition, they change their business model, they can become difficult to value. If Coles decides to restructure and do things differently, it's going to have a very different value. And God help you if you're valuing a declining company, where you expect revenues to shrink and margins to get smaller because there you worry constantly about, will this company make it? So across the life cycle, we're going to look at difficult to value companies. I'm going to look at emerging market companies. Why do a lot of US investors not want to invest in emerging market companies? Because they worry about things like cross holdings and corporate governance and family group holdings. And that's fine. But remember, more and more of the world is composed of emerging market companies. If you keep pushing them off your plate, saying too difficult, you might be missing some big opportunities. So I want to confront these issues with emerging market companies and talk about how do you bring in country risk and corporate governance, cross holdings into your value. And finally, I want to talk about valuing companies across sectors. Before 2008, I used to tell my classes, that banks were easy to value. Statement I've never been able to live down. But I'm going to explain why I used to make that statement that banks were easy to value and why I no longer make that statement. Banks have become some of the most complex companies to value, and we'll talk about why. Commodity companies. It's the biggest challenge valuing a commodity company, even if it's Exxon Mobil or Royal Dutch or British Petroleum. It's a big company. It's mature, But the oil price keeps going up and down, right? Imagine valuing the company a year ago, 2 years ago, and today. Think of how different your valuations could be just because the oil price changes. And finally, I want to go back to the issue of we capitalize R&D. I want to play that through. How does that show up in valuations? When I capitalize R&D and trace it all the way through, what effect does it have on value? Does it increase value or decrease value? You can be surprised at what we find. So let's start with young companies. So I want you to play the role of an entrepreneur. Many of you I know want to be entrepreneurs. It's the place people want to go. So let's say you're an entrepreneur, you've got this young, promising startup. Ready? I'm going to come to you with the 4 questions. I ask you, what is the value of the investments you've already made? What are your cash flows from existing investments? What's your answer going to be? What existing investments? I don't even own the chair I sit in. So that got easy. Then I ask you, what's the value you're going to get from future growth? You say a lot. So can you be a little more specific? Not really, right? You have no business model, no product. You have no idea what the market is. Then I ask you, how risky are you? And you say, very. Well, that's pretty much it, right? You can't show me past prices or past earnings. Then I ask you, when will you be a mature company? You fall out of the chair laughing. You don't even know whether you'll make it through tomorrow. Now do you see why most people don't even try to value young companies? Every question becomes a visit to the dentist and a root canal. So most people don't even try. And it gets worse. If you're a young company in a sector where every other company is also a young company, you have what I call the nightmare scenario in valuation. And let's think of why. When you sat down to value a company, think of the places you went to collect information. I assume to start with the company's financial statements, right? Annual report last year, income statement, balance sheet, statement of cash flows. You probably also looked at your company's history. What did you do in 2020, 2019, 2018, just to get a sense of what's a good year look like, what's a bad year look like. And then when you got stuck on something, you looked at industry averages. What's typical margins in the sector? What do typical companies do? In other words, you looked at the financials, you looked at the history, you looked at comparables. One by one, let me knock your crutches out. Let's say you're looking at a company, you're looking at a company, a young company. What's the first thing? What's the first crutch I knocked out? You have no history, right? If it's a young company early in the life cycle, there's nothing you're going to learn by looking at its financials because there's nothing there. So that doesn't help. And if every other company looks just like your company, they have small revenues and big losses, you've hit the trifecta. This is about as bad as it gets in valuation. You know what I just described, right? In the 1990s, this would have been the dot-com sector. Every single company had small revenues, big losses, lots of potential. And that's when the dark side will beckon. So what's the dark side? Here are some of the things it'll tell you. The old rules don't apply. Like what old rules? Things like you have to make money. That's so old-fashioned. You really don't need to make money. They say, why are you telling companies? Tell a macro story. What does that mean? Why should I buy a Rivian? Electric cars are going to be huge. Don't even specify how much huge is. Just say it's huge. It's a Kathy Wood push, right? Every company on our portfolio. And Kathy is a great macro trend forecaster, so don't take that away from her. But every single company in our portfolio, if you ask her, why did you buy Shopify? It's because there's a big market. Why did you buy DocuSign? Because it's going to be a big market. Why did you buy Tesla? It's going to be a big market. It's a macro story. And then you create pricing metrics that nobody has seen before. Why? Because you got to buy these companies. You can't buy them based on PE or price to book because they always look terrible. In the case of dot-com companies, you know what form this took, right? What did people start to do? They started dividing market cap of each company by website visitors. In fact, Mary Meeker, towards the end of the 1990s, came up with market value per eyeball. You know what market value per eyeball is? Hey, whoever it is that's got their mic on, could you please turn it off? Market value per eyeball, you took the market cap of each company and divide by the number of minutes people spent on your website. Let's face it, you have absolutely no frame of reference when I give you price per eyeball, right? When I say price earnings ratio of 500, you think that's a really high number. When I say price per eyeball is $350, you're thinking, I really like my eyeball. $350 doesn't sound like much. The problem with these pricing metrics is we have no idea what's high, what's low, which means you could be paying through the moon and not even realizing it because you come out. That is the dark side. So I'm going to try to pull you back to the light side to show you what I'm going to do. I'm going to go back to the 1990s, peak of the dot-com boom. I used to do these valuation seminars. And then at the end of the seminar, somebody would come up to me and say, you really cannot value Amazon.com using a discounted cash flow model, can you? And then this finger going like this, please step back, you're going to hurt me. The risk of grave personal injury, I would say, yes, you can value Amazon using a discounted cash flow model. And they'd give me this look of total contempt. Academic. That wasn't meant as a compliment. It basically meant you really can't do this. And they'd walk away. And after about the fifth or the sixth time of being called an academic, I got really pissed off. I don't remember the exact day in 1997 when I got pissed off enough to do something about it. I say, you know what? I'm going to actually value Amazon.com using a discounted cash flow model. And as I value the company, I realized there was nothing in the literature that helped me in valuing a young company. Nothing, including my own book. I read through it. No, I never talked about a young company losing money. So I kept a journal of every single brick wall I ran into and what I did to get over the brick wall. To show you how many brick walls I ran into. By the time I was done with the valuation, my journal was 75 pages long. So I slapped a name on it. The dark side of valuation, can Amazon.com be valued? And that became the first edition of the dark side of valuation in 2000 about all .com companies. So I'm going to cut to the chase. I'm going to take you back to January 2000. I'm going to set the table. January 2000 was the peak of the .com boom. The NASDAQ hit 5,000. Amazon was the poster child for .com companies. Everybody wanted to own Amazon. And I did a valuation in response to a request I got from AIMR, which is the parent organization for the CFA. They said, can you talk about value companies like Amazon? Because our members are really interested in how you value these .com companies. I said, okay. So I'm going to show you what Amazon looked like in January 2000. And I'm going to ask you to do something that's going to be really difficult to do. Do not bring the benefit of hindsight into those numbers, because you know exactly what's happened to Amazon over the last 22 years, right? So in January 2000, here's what Amazon looked like. It had revenues of $1.1 billion. Let me pause right there. A US retailer, which is what Amazon was in 2000, with $1.1 billion in revenues. It's a lot of revenues for retailer, US retailer. Even in 2000, Walmart had 200 billion in revenues. The Gap had 20 billion in revenues. This was a tiny company in terms of revenues. So file that away. It was a really small retail company. It had an operating loss of $410 million. So it's a small company which is losing a lot of money. Before we go any further, let me ask you a simplistic question. Can a company with small revenues and big operating losses become a valuable company? It's an easy question, right? Of course. Every company at some point in time. So let's stay simplistic. So help me out here. First, what's got to happen to the small revenues over time for this company to become valuable? Small revenues have to become big revenues, right? How do you make small revenues into big revenues? You need a revenue growth rate. I'll come back and show you the number I did, but that makes small revenues into big revenues. What's the second thing you need to fix? They're losing money. So for it to be a valuable company, they've got to make money. So your negative operating margins have to become positive margins. You got to tell me what the target margin is. If you look at my FCFF simple Ginzu spreadsheet and trace it back to its birth, it was from valuing Amazon that you start to see the inputs that you see still in the spreadsheet. What do I ask you? What's your revenue growth rate? I've added refinement since, but that's basically why I needed to make your small revenues to big revenues. What's your margin going to do? Give me the target margin. In the case of Amazon, let me show you what those two big numbers were. And I'll come back and explain why I picked the number that I did, because it clearly makes a huge difference to my value. In my initial valuation of Amazon, January 2000, I used a compounded annual growth rate of 42% a year for the next 10 years. It's actually 2 minutes into it was actually a very old fashioned webcast, because remember, this is 2000. They had a camcorder there and a cameraman. They're actually carrying it live. I don't know how they pulled it off. And I hadn't even finished saying 42%. When the first question comes through, it's email, because they say, how come you're being so pessimistic about future growth? I said, pessimistic? I'm making $1 billion in revenues into 40 billion over 10 years. I'm making it grow 40-fold. You're accusing me of being pessimistic. But you know why it sounded pessimistic then? What were they comparing the 42% to? The revenue growth rate in the most recent year for Amazon was like 200%. They're asking, why do you go? They missed the fact of the compounded annual growth rate. In fact, I was actually using 150% growth rate in year one, but as they got bigger and the company's scale increased, I had to bring the growth rate down. I thought it was a pretty upbeat story, billion to 40 billion. Then I looked at the margin. Right now, they're making minus 36.71%. If they keep making minus 36.71%, they're not going to be around for more than a couple of years. I had to figure out what kind of margin they would converge on after the pain of being a young company went away. So you know what I used as my target margin? 10%. That came from looking at brick and mortar retailers and what they were earning as pre-tax operating margins. You're saying, why don't you look at online retailers? Because they're all losing money. Second question comes in, how come you're being so pessimistic about future margins? You can see the undercurrent story there, right? Remember, brick and mortar retailers have all these fixed costs. They've got to maintain stores. You're an online retailer. Cost must be much lower. So complete the story, your margin should be much higher. A story that never made sense to me, and here's why. Let's say I told you in steady state, online retailers make 15% margins and brick and mortar retailers make 10% margins. Why is that not going to be a steady state? If you're a brick and mortar retailer, and that's what the steady state looks like, what are you going to do? You're going to shut your stores down, go online. You can't have two ways in steady state of delivering a business with wildly different margins, because the lower margin version is going to drop out. So I said, they're going to converge. This guy wouldn't give up. He said, why won't they converge to 15%? I said, because that's not the way the world works. Because think of what online retailing did to the retail business. Most of you, no, all of you are too young to do this, but if you'd wanted to buy a printer 30 years ago, you know what you did? You got in your car, you drove to the local electronics store, the Wiz or something like that in New York. You walked into the store and you went to the printer section, and the salesperson came up to you and he said, that is the cheapest printer you're going to be able to get. It was 1992. What are you going to do to prove him wrong? You could jump back in your car and drive to the next store, which is like 5 miles away, or take him at his word. In contrast, about 3 years ago, I remember when Best Buy started covering the codes on the sides of the printers. You know why they were doing it? Because people were walking in with their smartphones, scanning the code. So when the salesperson said, this is the lowest price you can get, they said, no, I can see 3 lower prices, and Amazon is 17% lower. If you're a customer, what online retailing did was it increased your power. And how does it show up? I think online retailing has lowered the margins for retailing in the long term because it's allowed consumers to capture some of that surplus. So I'm being optimistic, assuming margins will stay at 10%. I think in reality, they're probably going to drop to 8 or 7.5% by the time this whole game plays out. So I'm bending over backwards to be as upbeat as I can. I'm giving them high revenue growth. I'm increasing the revenues 44 and improving the margins. There's one final loose end I have to tie up. Amazon's got to go from $1 billion in revenues to 41 billion, right? It's going to take some work and capital. And this is where I actually got stuck on my Amazon valuation the longest, because there was nothing in the existing literature that I'll tell you some of the things I tried. I took last year's CapEx, depreciation, working capital, and tried to project them out. Completely useless, because with young companies, God only knows what happened in the most recent year. I tried the sustainable growth equation, return on capital reinvestment rate, not going to work because the margins are negative, the company is changing too much. And I think it took me about 3 days before I finally latched on to the fact that there's only one number that actually captures the growth of this company, which is revenues. And I had to tie my reinvestment to those revenues. Thus was born the sales to capital ratio that I asked you for in your company, because without it, I'm kind of sunk, right? I can't estimate the reinvestment. And I'll be quite honest, with young companies, there's no point breaking out CapEx, depreciation, working capital acquisitions, because they don't know what they will need to reinvest in, but they do know that they will need to reinvest money. I've consolidated all those items into one reinvestment number, and that's what you see here. And it's actually a very simple number. I use the sales to capital ratio of 3, which means for every $3 additional in revenues, I make you invest $1 in capital. You can do acquisitions, you can do R&D. That's basically, you have to do whatever you need to do. It's a pretty upbeat story, right? Revenues go up 44, margins improve, sales to capital ratio of 3. And that was actually at the highest quartile of the retail companies, because they said they'll be much more efficient than it. This is the one place where I did give them an advantage of being a brick and mortar, of being not a brick and mortar retail company. Notice though, how many more of my numbers are coming from looking in the industry. The 3M valuation I could say with the company numbers. At the young companies, you constantly have to look around because there's nothing in the company itself that you can use to make your projections. With my optimistic story, this upbeat story, take a look at what my free cash flows are for Amazon. Minus 931 million in year 1, minus $1 billion in year 2, minus $1 billion in year 3. Pretty much for the first 6 years, I'm projecting negative cash flows. Why are my cash flows negative? Because I'm so optimistic about it. That sounds weird. But the more upbeat and ambitious you get about the company, the more negative your cash flows are going to be, because you got to reinvest the money to get the growth rate. But there is an implicit assumption I was making here that I didn't even think about, honestly, in January 2000, that should have made me nervous. When you see a young company like this, and you've got negative cash flows in year 1, year 2, year 3, year 4, year 5, year 6, not just some negative cash flows, but huge negative cash flows. What am I implicitly assuming that Amazon's going to be able to do in year 1? What's that minus 931 in free cash flow to the firm tell you? What do they need to do? They need to raise 931 million in new capital. From where? Mostly from equity, based on my debt to equity ratio. Year 2, another $1 billion in equity. You see what my implicit assumption is? Markets are always open and accessible, and I will be able to raise that capital. Could that get me into trouble? Absolutely. Markets can't shut down. In a crisis, often risk capital shuts down. I'd have been much more worried about this assumption 1 year later after the markets had collapsed. But in 2000, I was oblivious to it. But my point is, when you value young companies, you're making the assumption implicitly that access to capital is not drying up, because if it does, you're never getting to nirvana. You see where nirvana is in my valuation? Where does the big value come from? It comes from getting to year 10. I'm not getting there if I can't raise the capital to go through the first 6 years. So I've got my cash flows. I need a discount rate to use to discount those cash flows. So I'm going to come up with costs of capital. Let me repeat that again. Costs of capital, not one cost of capital, but costs of capital. Let me explain why. When I start this valuation, what does Amazon look like? A young money-losing company, right? Where would you put that in the risk spectrum? It's a young money-losing company. Would you expect it to be riskier than the average company or safer? It's going to be riskier. And I gave it all the characteristics of a risky company. Not a very high debt ratio. They can't afford to borrow money. Beta 1.6, reflecting the fact that they're online first, and retail is kind of an afterthought. I came up with a cost of capital of 12.84% in year 1. Makes sense, right? Young money-losing company. But take a look at my own projections. By the time I get to year 5, I'm giving Amazon $19 billion in revenues and $1.7 billion in operating profits. In other words, in my story, Amazon, by the time I get to year 5, is a bigger money-making company. And by the time I get to year 10, it is it's a $40 billion revenue company making a huge amount of money. Do you think my cost of capital should change as my company changes? Absolutely. It should become lower because I'm making my company safer. This is the one thing I've never understood in conventional discounted cash flow valuations, where people pick one discount rate and they just leave it at that number, even as the company changes. Be internally consistent. In this case, my cost of capital decreases from 12.84 to 9.61%. If you look at all of my valuations, you'll notice my cost of capital changes over time. Less in a mature company, more in a riskier company. And when your cost of capital changes over time, there's one mechanical thing that happens that if you're not aware of, you could miss. Normally, when I ask you to compute the present value of a cash flow in year 5 in Excel, what do? Use the present value function, right? When you use the present value function, you're assuming your discount rate is the same for the next 5 years. You cannot use the present value function once your cost of capital starts changing. Because discount my cash flows in year 7. You know what I need to do? I need to discount back at 12.84% for 3 years. So basically, my denominator will now be this compounded cost of capital, reflecting your changing cost of capital over time. In my Excel spreadsheet, you might have wondered why there's this compounded cost of capital line. It's precisely for this reason. I cannot trust Excel with my present value because my discount rates are changing over time. So I overcome that mechanical issue. I take my cash flows, I discount back at the cost of capital. What I get as a present value is 15.17 billion. That's a value that I'm attaching to Amazon, assuming it becomes this $40 billion company with 10% margins. I add cash, 26 million, not very much. Subtract that, 349, almost nothing. And then I subtract out equity options. Remember when we talked about options, you probably said, why are we wasting our time? This is such a small part of a company, it shouldn't make much of a difference. Now do you see why I spent so much time on the option part? In the case of Amazon, the options they've given away as a company in the 1990s, they've given away a quarter of the company to employees, to management, to CEO. That's out of my equity. I subtract out the options. I divide by the number of shares. I get a value per share of $35. Now, when you do valuation of real companies, which is the only kind of company that I've had, I don't value XYZ widget company for a simple reason. It's pointless. You're always 2 questions away from being exposed as a fraud, right? When you see the value of a company, what's the first question you ask me? What's the market price? It's a publicly traded company. So let's say the value that I get for a company is 50 and the market price is 30. Ask me the next question. The next question is going to tell you whether it's worth even listening to me past this point. What's the next question you need to ask? Value is 50, stock price is 30. You should ask, am I buying? And I can give you 3 possible answers. No. In which case, what have I told you about my own valuation? Nice number crunching exercise, but I don't believe any of it. I can say yes and lie. You have no way of checking. Or yes and buy. And half my portfolio is composed of companies that have been almost trapped into buying because I value the company. Say, are you buying? And I want to keep these people listening for the next 2 hours. I either buy or I lie. Sometimes I've lied, but most of the times I buy. But ask me the analogous question here. Here, you're obviously not asking me whether I was buying, right? My value is much lower than the price. But what is the analogous question you'd ask me to see if I trust my valuation of Amazon? Did I? If I find something to be significantly overvalued, what's the question you ask to see if I'm willing to act? Would I short, right? Obviously, you ask me, will I sell? I'm going to evade the question. I'm saying, I don't own it, so I can't sell it. But can I short? What does that mean when you short a stock? What are you doing? Does anybody know the mechanics of shorting a stock? You're borrowing shares from somebody. You're selling the shares, even though they don't belong to you, and promising to return the shares back at a point in time in the future. So when I finished this valuation, the last question I was asked was, would you short? And I said, not in this lifetime. He said, don't you have enough faith in your own valuation? I said, I feel more confident that Amazon is overvalued in January 2000 than most of the companies I've bought, which are undervalued. So I'm going to ask you a question. This is kind of a question that goes to the core of investing. And this is still true of much of my investing. I'm far more likely to buy something undervalued than sell short something that is overvalued. Why is that? It's not just me. I think collectively this is going to. Well, unlimited losses, that's going to take a long time to get, right? It's not that, if that were the only issue, I'd be selling short a lot more. Yeah. In fact, complete the story. When I buy something that's undervalued, how long can I wait? As long as I need to, right? If I'm a portfolio manager, I don't have that freedom because clients may ask me, why did you buy that? I buy with my own, the only person I have to answer to is my spouse. And I've turned off the Schwab accounts that tell me what's in the portfolio. She doesn't even know at any point in time. So I can wait and I can wait and I can wait. Time is my ally. When you sell short, how long do you sell short for? It's actually not within your control. You know what a squeeze is, right? When you sell short, a squeeze basically means people have bought enough shares that the person who lent you the shares wants them back today. You're saying, but you told me I could have it for 3 years. No, I want it back today. The problem with selling short is your time horizon is not in your control. Not only do I have to feel confident that Amazon is overvalued, I have to feel confident that the correction will happen really quickly. If not, I'm going to be taken to the cleaners on these stocks. You know how many people have lost their shirts on Tesla by selling short on the company? I would never sell short on a Tesla. It'd be devastatingly dangerous because if the float is small and there's enough trading, enough mood and momentum against you, your time horizon can become 3 weeks or 6 weeks or 10 weeks very quickly. For every 10 stocks that I buy and hold, I probably do one short sale, usually on very liquid stocks where I'm not worried about float changing, squeeze happening. So it's one of the great asymmetries in investing. It means when things get undervalued, there's this bargain basement strategy that keeps them from going below that floor, right? But things get overvalued, I'm not sure what you do. So bubbles can get really big on the upside because there's no obvious way to take advantage of an upside bubble. So I'm going to take this valuation and draw a few lessons from it that I still draw on whenever I value a young company. Remember what I said about not trusting regression betas? That goes in spades when you're valuing a young company. For God's sakes, don't go to a Bloomberg terminal, look up the beta for Shopify and value Shopify because what you're getting might be pure noise. Let me explain. This was the Amazon beta page from 2000. See that raw beta? That's my regression beta, 2.23. Take a look at the standard error of that beta, 0.50. The true beta for Amazon can be anywhere from 1.23 to 3.23. So what do we do? Do what you do for any company, right? So if using a regression beta, you look up the beta for the business they're in. With young companies, you get a little more flex. And let me explain. For Amazon, early on, I used the average online beta of online retailers. Why? Because early on, that's what I think about. In 2000, when you told Amazon, I thought online, oh, by the way, they're in retail. But by the time you get to 19, 25, 30 billion revenues, it kind of flips around and say, oh, what's Amazon? It's a retail. Oh, by the way, they're all online. So the way you think about the company might shift. So even though you're using a bottom-up beta, what you use as your comparables can shift for a young company from the first 5 years to beyond. That's what gave me the 1.6 beta for the first 5 years. And a beta 1, the average beta for brick and mortar retailers beyond. Second, and this is the big assumption, and hopefully this might help you when you think about what to use for your company. Remember that 42% compounded annual growth rate for the next 10 years? The 10% target margin, those were big assumptions. In fact, if you ask me to isolate the two biggest assumptions of valuation, those are the numbers. So I'm going to lead you through how I picked the 42%. And second, how I got them from where they are now to the 10% margin. We start with the first question. Again, I'm going to take you back to when I first valued Amazon. I did it the way I was taught to value companies, which is to move sequentially through time, right? Year 1, then year 2, then year 3. And I realized by year 3, I was pulling my hair out because I was reaching point. I have no idea what I'm doing. So I stopped. I said, if I keep doing this, I will never get to year 5 or 10. And that's basically what often happens to people valuing young companies is they try to move sequentially through time and very quickly give up. So I think, what's your alternative? I know this is going to sound vaguely new age, but hang in there with me. To value a young company, you got to visualize what success will look like for this company. Let me make that specific. I liked Amazon in early 2000. I liked the way Jeff Bezos was running the company. I liked the way it had grown. And I wanted to ask, what will success look like? I thought Amazon would be successful, but I wanted to say, what will success look like for Amazon? Remember in 2000, it was almost entirely a retail company. So if I want to see what success looks like for a retail company, you know what the best way to get perspective is? Go look at other retail companies, see how much they have in revenues, what their margins look like. So I took a list, I would think of the 10 or the 20 biggest retail companies in 2000. At the top of the list was Walmart, and I said you had Costco, and I don't know whether Costco was even around, but Gap, Limited, etc. So the question I asked was, where on this list do I expect Amazon to be if it's successful? Will it be as big as Walmart? In early 2000, I said, no way. It's not got the range of products. It's not a discount retail. It's not going to be like Walmart. I said, will it be as small as the Gap? I said, no, Gap sells only apparel. They're going to sell, Amazon sells more. This incredibly scientific process I'm using, I moved back and forth and finally said, you know what, I'm going to put them somewhere between the 5th and the 6th largest retailers. You know what the 5th largest retailers' revenues were? Like 42 billion. The 6th was about 40 billion. This incredibly scientific approach led me to about 41 billion. And the rest, as they say, is just filling in the gaps. So my starting revenue is 1.1. I need to get them to 41.3. If you ask me why, no, how do you come up with these growth rates? I'll make a confession. I just made them up. And if you made a big deal about these growth rates early on, I'll give you the growth rates. So if you said, you know what, year one growth is 163.35%, you can have them. You want year two, take that as well. If you give me the starting and the ending points in this valuation, I control the valuation. That's why when you value a company, don't get focused on the growth rates. Look at the end revenues. That is the big part of your story. Because if that part is right, it doesn't matter that you underestimated growth in some years and overestimated in others. The value you're going to get is going to be pretty much the right value. Now you can already see why there can be room for disagreement, right? You could have looked at Amazon and said, I think it's going to be far smaller, used a 25% growth rate. Or you can say it's going to be as big as Amazon, as Walmart, and used a 60% growth rate. But in my story, the revenue growth rate is 42%. We do the other half of the story and we'll end for today. What are my margins? Minus 36.7%, right? Where do I want to be? 10%, which is the brick. You see, how do you come up with the middle numbers? They look magically precise. Minus 13.35. So I'm going to ask you a question. I know it's late in the class. You're probably exhausted. I want you to try to guess. I mean, I used a very simple algorithm in my computer to get the intermediate margins. Can you guess what that algorithm is that lets me get from? So the only numbers I know is minus 36.7. So when I first started the spreadsheet, all these middle numbers were blank. What do you think the algorithm is that I used to get from minus 36.7 to minus 13.35? From minus 13.35 to minus 1.68. It's not a con. You want to, somebody want to try? I'll help you out. Where am I now? Minus 36.7. Where do I want to be? Plus 10. What's the distance between the 2 points? 46.7. I took half the distance to my goal. That brings me to minus 13.35. Minus 13.35, 10. Take the distance, divide. You're saying, why half the distance? Why not? When I build spreadsheets, I build them with a very specific intent. If you disagree with me, I want you to be able to change a number. When I move half the distance, I'm moving pretty fast towards, I'm assuming a fairly smooth pathway to profitability, right? Let's say you look at Amazon, you agree in my growth rate, you agree in my margin, but you say, you know what? I think it's going to be much more rocky. They're going to lose money for a longer period. You know how you can make that happen? Make the half into a quarter of the distance. What is that going to do? I'm going to have the same starting point, the same ending point, but I'm going to lose more money for a longer period. With young companies, you want to keep things simple. You want to have levers you can move because things will change. People will disagree with you. You will disagree with yourself. 2 weeks from now, 4 weeks from now, if you've hard-coded these numbers, God help you, you're never going to revisit the valuation. So if you look at the end game here, my losses become profits. One final point. If you look at the after-tax operating income, it's the same as, so in the first 2 years, I have no taxes for obvious reasons. I'm losing money. But in year 3, I'm making money, but I still don't seem to be paying taxes. Why not? Yeah. I'm tracking your losses. That's the spreadsheet does that right now. So it takes the NOLs, tracks the losses, and protects you from paying taxes. It's already built in. There's nothing for you to do. So when we come back, we're gonna finish up this valuation of Amazon and keep moving through the dark side. So I'll see you on Wednesday.
Yep.